Hello everyone, this is Erica from Trader Babes, and in this video I'm going to show you 3 basic ways for trading the downside or downtrend or drops, even the pullbacks. But before we get into all that, don't forget to like and subscribe if you haven't already. Also, I wanted to tell you all about the brand new Trader Babes shop we just launched. The link for that is shop.traderbabes.com. I also included it in the video description below. There is so much cool merchandise, and I really hope you guys check it out. And let's go ahead and get started. 3 basic, simple ways for taking advantage of that downward movement. Now, most people, when they think of that, they think of traditional short selling. Now, that's true. That is one of the ways to take advantage of that, but a lot of people have a misunderstanding of what that means. So let's clarify that in really basic terms. Short selling, all that is you are borrowing shares from your broker to sell on the market, and the goal is to buy back those shares for a lesser price, and you are profiting from that difference. Now, there are a few disadvantages of short selling that you may not know about. The first is that there is a borrow fee for borrowing those shares that your broker charges. With hard to borrow stocks, and a lot of times this will be heavily shorted names or momentum runners, the fees can vary greatly. And with those hard to borrow stocks, it's going to be significantly higher, and that really cuts into your profit. Another disadvantage is that a lot of brokers do require you to have a margin account if you are going to be short selling, which means if you have a cash account, that kind of leaves you out. However, there's more than one way to take advantage of downward momentum. So besides the first, short selling, the second that a lot of newer traders may not know about is what's called the inverse ETFs, or even leveraged ETFs. Now, what those are is very simple. Inverse ETFs are the inverted action of that underlying ETF. For example, an inverse ETF from SPY will do the exact opposite of what SPY is doing. One of the most popular ETFs to trade is UVXY. That is because it has such a lower price point, so a lot of traders feel comfortable trading it. But there are so many to choose from. There's various ones that follow the market, as well as different sectors and industries. Now, with your leveraged ETF, what that means is that is magnifying the movement. So you have your 1x, your 2x, and your 3x leveraged ETFs. And again, this allows you to trade larger market-wide action without having to know how to do option strategies and without having to short sell. Now, it is important to know that a lot of these inverse ETFs, particularly the leveraged ETFs, are not ones that you are holding long term or for any significant period of time. They really are made to take advantage of the shorter term moves. So really your intraday trading, most traders really don't hold them even overnight. But it does give you a way to take advantage of that movement. Now, besides the advantages that I just listed, another great thing about these ETFs is that when it is an inverse, and you are trading that, you don't have to worry about changing your bias. Now, most traders naturally have a bullish bias, a bias to go long, and it can be difficult to see the other side's perspective. Now, in my opinion, and from a lot of different traders that I've talked to, it is extremely important to learn how to see things from both perspectives, not only for taking advantage of downturns, but also when you are trading from a long position, knowing what the shorts or the bears are looking for really helps you fine-tune your entries, fine-tune your strategies, knowing how that other side sees your trade. Of course, we want to learn as much as we can in trading, right? The third method that I wanted to tell you about is with a basic options single leg. Now, a single leg in options, all that means is that you are trading a single contract. It isn't an options spread. You may have heard that word used quite a bit, and it's true. There are so many different strategies and spreads to use with options. A single leg also means that you aren't owning the shares and then writing calls against it or hedging your position. It's just trading that single contract. And when you are doing an options leg, you are going to trade puts. Now, puts is when you're expecting the stock to go down. Calls is when you are expecting the stock to go up. So taking a short position would be puts, long position would be calls. Now, depending on your preferred trading strategy, your criteria for choosing that option is going to be different. Typically, I like to look for a delta of 0.30 or higher. And then I also pay attention to things like the IV. Traditionally, any contracts that are higher than 100% IV can be more difficult to trade. But we're not going to get into all of that detail because that's for another video. But if you wanted to simply trade the downside, you would buy a put. Now, like I was just explaining, a lot of traders really have a hard time seeing the bearish position. And there's a cool little trick on Thinkorswim that a lot of traders like to take advantage of when trying to see things from both sides. And you can see if you like it as well. So I'm going to pull up a chart of Apple. Here is the 4-hour chart, the regular one. Now, what I'm going to do here is I'm going to invert that chart. And that's going to help me see things from a whole other perspective. And the reason a lot of traders like to do this is because it helps them look for the same patterns that they're used to looking for, the same trends, but knowing that they are trading the opposite side. And all you do in Thinkorswim is add a dash or minus sign in front of the stock name. So minus Apple, and that inverts my chart. And it really helps you see things from another perspective. Some traders don't like to use this. I personally don't use this that often because I do like identifying bearish and bullish movement. But if it is something that you are struggling with seeing the ways a stock can go down, then this is just one of the little tools that you can try. Now, with this video, we're not going to go into all of the different methods for a short trading strategy, everything to look for, but let's talk about some of the most prevalent ones. These are going to be your bearish patterns, such as your head and shoulders or bear flags. You also want to look for signs of overextension on the chart, and also really reading the volume in buying versus selling. And I can make another video to go into that a little bit more in depth. But there are plenty of ways that you can analyze a chart to see all of the different ways it can go down versus all of the ways it can go up. And you really kind of want to weigh the two when you're going through and analyzing what position you want to take. So just to recap, the three basic ways for taking advantage of downtrends in the market or a stock is: first, traditional short selling. The second is by using inverse or leveraged ETFs. Again, this really allows you to expand your trading into taking advantage of the full market action. And the third is options, which of course allows you to expand into that area as well. But if you are looking to dive into options, make sure you check out some of our videos with options traders that we have done so you can start to learn the basics before diving headfirst into it. So thank you guys so much for joining me. Don't forget to check out the Trader Babes store, and I will see you next time. Want more Trader Babes? Subscribe now and connect with us on social media for exclusive content and access you won't find anywhere else. And we'll see you right here on the next unforgettable episode of Trader Babes.